And me, Kenneth, Andrea, Raquel, Michael, and Jacob gonna talk about stock trading as a service. And so before we talk about the future of stock trading, let's talk a little bit about how it all began. So stock trading started in 1791 in Philadelphia, 1792 in New York, and the New York brokers created New York Stock Exchange in 1917 to regulate the tradings and to create more rules and also to facilitate more tradings. But after 2 centuries later, and many financial crashes made, uh, technology grew, and the amount of people that's trading also increased. So investment firms are trying to get market share to get this amount of traders. So the numbers of the numbers and for the fees are getting lower and lower, and people are trying to provide better service. And so we're now we're discussing about how it's going to affect the future of stock trading.
Stock trading as a service is part of the wealth tech segment that it consists of companies that provide alternatives to traditional wealth management services. Products offered within this industry include online investment platforms, run-out services, low or not fee investment products, and more. The market size was estimated to be 1.5 trillion in 2019 and is expected to grow to over 6 trillion by 2023, with a compound annual growth rate of 32.1%. Well-tech companies make revenue by subscription models, interest from cash held uh, in customer accounts, or transaction fees.
So I want to talk a little bit about the companies, and there's Merrill Edge, eToro, and TD Ameritrade. Merrill Edge started in 2010 from a merger from uh, Bank of America's trading platform and Merrill Lynch's research tools and customer service. So from there, they cater around the clients of Bank of America, and they provided $0 fees to trade stocks, ETFs, and options. And this is very good for beginners because they provide and curate all the research tools for beginners and also even provide college investing. And eToro, as for eToro, it's a social and trading and multi-asset brokerage firm. You can see how top traders trade and even copy their portfolios. And as for TD Ameritrade, as you all know, they're being bought out by Charles Schwab for 26 billion. And TD Ameritrade covers a lot of different kinds of investments like stocks, like fixed income investments, mutual funds, and many more. And they don't and to penetrate the market, they don't have any account requirements.
So next up, we feature some of the startups that are driving and pushing the industry forward. So first of all, we have Alpaca and DriveWealth. These two startups in particular are using technology by making APIs, application programming interface, that basically offers an infrastructure that smaller fintechs and other companies can use. So this technology not only brings features such as thematic investing, but it also brings other features such as fractional investing and loyalty and rewards programs. So without these fundamental companies, smaller companies wouldn't be able to offer such services. Next up, we have Robinhood and Gemini. Now, Robinhood is a FINRA-based and SEC approved company that's making very, very big waves in this space, as well as Gemini. Uh, Robinhood, in particular, recently started offering savings and checking accounts for some of their customers. Another very interesting player in this space is Acorns. Now, Acorns, every single time a customer or a client swipes a card, every single transaction, the change is rounded up to the nearest dollar for savings. And from there, people can now invest not only in options, but also 7 different ETFs. Therefore, these startups are very innovative in this space.
Now we're gonna compare the startups. 4 of the 6 startups that we investigate, their commission is free. Robinhood is the one who started with this zero commission, and it became so popular that even established companies are offering it. The startup with the best rating is Acorns, and the one with the highest weekly growth rate is Alpaca. Now we're gonna compare the established companies. that only two of the six established companies that we investigate, their commission is not free. Wealthfront has the best rating, and Coinbase has the highest weekly growth rate. If we compare the startups and established companies have more employees and their growth rate is higher than startups. This shows that they are still innovating on the platform. And another international fintech company that is transforming the platform is WeChat. WeChat is a clear example of how the future is going to look when banking and are combined. WeChat is also known as the app for everything because it enables the users to send messages, receive money, scan a QR code to make payments, manage credit cards, and more. The application has over 1.15 billion of active users who use the app to make payments on a daily basis. The majority of the users are from China, however, it is expanding into Europe and the USA.
Throughout the years, stock trading as a service has been changing quite a lot, which is why throughout our research we have decided to support this claim. And we have found three facts that clearly supports this claim, which is that the entry bar has been lowered, trading has been made simpler, and there's new opportunity that's open for big financial institutions too. And let me tell you how the entry bar has been lowered first. Companies such as eToro, they have been doing something called the copy trading strategy, which their customers can copy the trading strategy of the top performers and making it easier for them without them having to go to a professional to pay for a fee for it. And then companies nowadays they have been also doing a lot of fractional shares trading, which makes it a lot easier for us, especially as students, since we don't have that much money to invest. It just makes the entry bar lower. And then the entry has trading has been made simpler because of the technology that's available out there. Uh, Data has shown that 70% of the trade made in the US has been through a automated trading program, which a lot of companies these days are using, just making it a lot simpler. One example would be Wolfram, that they offer things like that. And then companies such as Charles Schwab, which acquired TD Ameritrade, through these acquisitions, they're making moves that could open up new opportunities for them.
The main takeaways we want to share from our analysis is first, that consumers are increasingly choosing fee based investment products over commission based products, and they are adopting more passive investment strategies over actively managed strategies. This is creating opportunities for automated products that rely on modern technology as opposed to traditional relationship based products and services. According to PitchBook, passive investment will reach $57.7 trillion in 2025, representing 40% of the total global asset under management. Second, large financial institutions are competing with fintech companies for customers. Discount brokers like eTrade, Schwab, Fidelity, and TD Ameritrade have all eliminating trading fees. This puts a lot of pressure on fintech companies to compete against deep-pocketed legacy players with established customers, and it also increases their customers' acquisition cost. And finally, we want to point out that collaboration, not competition between fintech startups and incumbent institutions, will disrupt the market. According to a Deloitte study, financial institutions are far more likely to collaborate than compete with fintech firms. It's all about learning from one another and creating complementary business models and capitalizing on emerging opportunities benefiting both parties. Thank you.